Hello everyone, welcome back. My name is Arias, and today we're going to be talking about TDOC and their entire business through the lens of Primary 360. If you're anything like me, while you've been listening to TDOC's communications, you've heard of Primary 360 and whole person care come up plenty of times and wondered what exactly those buzzwords meant. We'll get into that by looking at a few slides from their Investor Day back in November, as well as the financial model I built for the next few years based on their guidance. Don't forget to like and subscribe if you enjoy this type of content, and leave any other video suggestions and feedback in the comments below. And without further ado, let's get into it. Let's get right into what exactly Primary 360 is. Primary 360 is TDOC's primary care product. They use their AI to match you with a list of primary care physicians from your regulatory area who they think will fit you best. Then they allow you to easily schedule a meeting with them via TDOC's app and virtually meet them from the comfort of your own home or wherever else. Then this person serves the role that a regular primary care physician would, being the first point of contact for all of your medical care needs. They can or will be able to do all of the things a normal physician would, like ordering blood work or labs, giving prescriptions, or setting up vaccinations, all through TDOC services. This in itself is a valuable service to consumers. Additionally, TDOC patients can see their new doctor quickly, which is important for follow-through. Primary 360, or P360 as the management team has termed it, drives greater than 10 patient care team interactions a year, and all of that is driving results with 90% plus performance with preventative screenings and follow-ups. Most importantly, P360 has a 95% plus consumer satisfaction rating, which demonstrates the value that consumers are assigning to this service. But here's where P360 has a chance to drive monumental value for TDOC. Primary 360 networks extremely well with all of TDOC's other consumer offerings. Through Primary 360 and the app, the physicians will be able to seamlessly and easily refer the patient into other helpful things that TDOC provides, like mental health counseling, chronic care management via Livongo's offerings, nutrition help, or urgent care. This will help drive incremental value for TDOC by acquiring customers for each of these branches of TDOC's tree without any additional marketing spend, while also clearly driving value for the consumer by the sheer amount of help they can receive. This should also lead to dealing with issues earlier when they are both cheaper and easier to deal with, saving the insurance provider money long term and giving TDOC an opportunity to grow their base and earn more compensation for saving providers money. Ultimately, Primary 360 will provide care for more people at lower prices, which saves lives. In the United States and all over the world, there are more people who need high quality healthcare than there are healthcare professionals to give this high quality care. This forces different ways of deciding who gets healthcare, with the main dichotomy being between countries who force people to pay and ration care in that way, or who force all people to wait or get less care and ration it in that way. TDOC is trying to solve this problem by making high quality healthcare more available by maximizing the use of the resources available today and shifting that availability to where it can be best utilized. This is what I see as TDOC's primary mission that they are solving for, and Primary 360 is another step in this direction. Before we move on, let's take another slightly more detailed look into what exactly Primary 360 is via another slide from their Investor Day. Starting on the top left and going clockwise, there is a dedicated care team for each member so they can stay up to date and stay on track. They develop a longitudinal care plan that flexes over time with patients to better meet their needs. Members have continuous 24/7 guidance and support, again, to keep them engaged with their health goals and keep them on track. Like we were talking about at the end of the last slide, TDOC makes it easy to connect patients with specialty providers in their network, as well as providing them last mile services that enables their physical care to be given at home. This all adds up to TDOC providing a unified whole person care experience covering a wide spectrum of needs, as you can see listed here. This should answer what exactly Primary 360 is, so let us now move on to what implications this has long term. Moving on, in this slide, we will dive more into how Primary 360 will serve as a gateway to TDOC's growth going forward. We've talked about this pretty extensively thus far, but Primary 60 will enable TDOC to easily get their patients access to their whole person suite of products. As you can see here from their Investor Day, 80% of the population could benefit from one or more TDOC products. The majority could benefit from general medical help at around 60%, while the rest of the products, including chronic care, mental health care, nutrition, expert medical services, and dermatology, could benefit about 25 to 30% of the population. Expansion of these services represents a tremendous opportunity for TDOC to expand their revenue per member. In fact, on this excellent slide from their Investor Day, they tried to quantify that growth opportunity. They started with the 92 million people that have access to TDOC products today and estimated how many could use their core offerings and represented that in purple. They estimated 75 million could use Primary 360, as some of the population already has a strong relationship with their primary care physician. They estimated 51 million could use My Strength Complete, their mental health offering. 47 million could use their diabetes, prediabetes, or hypertension management product, and 19 million could use their weight management product. Then they gave a range of total revenue per member per month, which was $25 to $40 for P360, $30 to $40 for My Strength Complete, $50 to $110 for diabetes, prediabetes, or hypertension management, and $30 to $65 for weight management. If you total all of this up and look at the revenue numbers, if there were 100% participation over the 92 million members that already have access to a Teladoc product, that would imply a revenue range between 75 and 137 billion per year, up from 2.6 billion projected in 2022, and per member per month revenue of $68 to $123. Keep in mind that this assumes Teladoc doesn't grow the number of people with access to their service at all, which will certainly not be the case. These will both obviously be massive increases and I think would justify a massively higher valuation, even if they were just able to achieve a fraction of that. For example, if they've achieved 10% of the low end of the revenue at a 30% profit margin and a 30 multiple on that profit, $7.5 billion in revenue would be $2.25 billion in earnings, which would imply $67 billion of valuation. Or if they did 30% of the low end of the revenue at 30% profit margin and a 30 multiple, that $22.5 billion in revenue would be $6.75 billion in earnings, implying over a $200 billion valuation. Both of these are clearly significantly higher than the current approximate $13 billion valuation. Moving back to the fundamental advantage that Teladoc has going for them that will help them achieve this growth is that they have all of these services in one place, which makes it much easier for them to cross-sell and provide what they like to call whole person care. One final slide from their investor day before we move on to the short-term financial model. Teladoc's management shows two things which I think are true keys for their growth going forward. On the left of their slide is their potential for membership growth. As you can see, in the US alone, 92 million have access to Teladoc's products, with 76 million actually being enrolled and 16 million being offered but not enrolled. They show 63 million in potential new population that is already within existing clients and 92 million that are outside of the existing clients. They show an additional 51 million lives that are Medicare and Medicare fee-for-service patients that they have the potential to pick up. Totaled up, there's 206 million additional lives that they don't yet have access to. If you look at it on a percentage basis, they are just 30% penetrated, and this is just in the US alone, their most developed market by far. Another potential for growth is not just organic growth in foreign markets, but potentially getting in with massive socialized healthcare systems that exist, especially in Europe. Management said that they were having discussions with these entities, but did not include this into any of their financial projections. This would be a massive windfall for Teladoc, but as you can see, it is not required for their continued growth, as there is plenty of white space in the US market alone. On the right side is the other half of the equation, revenue per member represented by how penetrated each of the products are. As you can see, the legacy telemedicine is the most penetrated product, with 82% of the 92 million lives having access. Mental health telemedicine is second with 35% penetration, followed up by legacy MyStrength and diabetes and hypertension management at all around 20%. Getting into the least used products, weight management and prediabetes are at 4 and 2% penetration respectively. These are extremely pervasive problems in our society, and a lot more than 4 and 2% of the population could use help with their management. Finally, Primary 360 and MyStrength Complete both have under 1% penetration and represent huge opportunities for Teladoc to expand their per member per month revenue. These two areas, member growth and product growth, make up Teladoc's opportunity to grow revenue going forward and are the two keys to the success of their business long term. Moving on, this is my short-term financial model for Teladoc based off the guidance given on their investor day. On Investor Day, they broke out their business down into 3 segments: virtual medical care, mental health business, and chronic care. They advised that these made up 35, 40, and 25% of the business respectively in 2021, which if you break that down from the approximately $2 billion in revenue in the year, means virtual medical care did about $700 million, mental health business did about $800 million, and chronic care did about $500 million. They also gave expected compound annual growth rates over the next 3 years of 10 to 20% for virtual medical care, 30 to 40% for mental health business, and 25 to 35% for chronic care. I did the math extrapolating all of these numbers out for the low, mid, and high range of each of these guidances. The mid-range would imply about $4.1 billion in total 2024 revenue, which is in line with the guidance of at least $4 billion, with mental health making up the majority of that, contributing at about $2 billion, with the other two sectors chipping in about $1 billion each. This would imply about 27% year-over-year revenue growth, and I was a bit disappointed in this when I ran the numbers. I was forecasting above 30% growth over that time period, which is what we see if they achieve the high end of the projected growth for all segments. Shifting gears to talk about their adjusted EBITDA margin, they're guiding for 1 to 1.5% growth each year CAGR out to 2024, with the exception of 2022, with 75 basis points of that growth being pulled forward into 2021 due to merger-related changes. If you extrapolate this out, it yields adjusted EBITDA margins of 15.25% for the low range, 16% in the mid-range, and 16.75% in the high range. Now, if we move back over to the right side and take the revenue numbers and these calculated adjusted EBITDA numbers, it yields about $560 million, $660 million, and $780 million in low, mid, and high cases for projected 2024 adjusted EBITDA. If we apply multiples of 30, 35, and 40 to each of these, it would yield valuations of about $17 billion in the low range, $23 billion in the mid-range, and $31 billion in the high range. With these expectations, the mid and high ranges would deliver solid compound annual growth rates of 22.7% and 35.6%, while the low range would deliver an anemic 10% CAGR for growth investors. Thus, in my opinion, if you're going to be invested in Teladoc, you have to be much more bullish than the low ranges management are projecting, which I am. Keep in mind that financial modeling is an inherently fraught endeavor, and no amount of scrutiny will get these 3-year-out numbers to be correct. Despite this, I like to go through this exercise because it better helps me determine the potential going forward, and thus how much I'd like to buy of each business. This is not financial advice, of course, and you should make your own model, and let me know what the results are in the comments below. Finally, my conclusions. Teladoc clearly has a superior product suite for giving medical care that is providing value to customers in the market today. However, I still have reservations about whether or not it will be enough to drive mass adoption that is needed to dramatically increase their valuation. The big separators are having a whole suite of products to provide to customers, and the fact that this includes Livongo, a data gathering machine. Now, what do I think Teladoc should do that would give them a massive leg up? Buy out one of my other favorite companies, Invitae. I think Teladoc needs to make a massive move into genetics, which may become the ultimate data point to search for correlations with their chronic care products and to make this care more effective. Imagine if every chronic care patient and P360 patient had their genome sequenced as part of the Livongo and P360 onboarding processes. They could then go to work looking into what parts of treating each of these diseases is most effective based off what their specific genome is. They could also use this information in their primary care practice as well and start the process of deciphering and unlocking the vast amount of data that is stored in each person's genome. It would also help Invitae's data business, as it would give them access to significantly more genomes to take a look at in studies and take learnings for. Of course, this probably won't happen for an amalgamation of reasons, but nonetheless, I'd like to see TDOC make some sort of move into genomics, which hold these immense potential for healthcare going forward. Now getting to the bottom line with what I've been doing with my position in Teladoc. I have been adding, but not as aggressively as I have been with other positions, and this is due to the generally slower growth than is expected in almost any of the other companies I hold. Teladoc has a clear problem to solve, and they have a clear pathway to contribute to solving it. However, I am less confident in their management execution than I have been in the past, and I will keep a close eye on their execution and how they stack up to their promises going forward. Thanks for watching. What do you think of Teladoc, and what's their long-term potential? Are you interested in owning the stock? And what's your 2024 price target? Let me know in the comments below. Also, let me know if you'd like to see an update to the model that I showed in the first Teladoc video with projections going on to 10 years. Thanks again for watching and have a great rest of your day.